Welcome to the Nichols Tax Update Podcast, issue number 2109 for March 1st, 2021. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. Before we go too far, I must acknowledge the value of my subscription to Tax Notes Today, published by tax analysts, the preeminent source of information for tax professionals for over 50 years, without which I could not prepare and present this program. With that, let's see what we've got. 5 topics, an average week, as those of you who are with me every week know. Our first item deals with an income tax liability which is not dischargeable in bankruptcy because the return that reported the liability was simply not filed on time. We're going to have a lot of bankruptcy filings coming up as a result of COVID-19, and there will be CPAs who will be representing clients that are trying to get out from under their debts in bankruptcy. It's really important that you file all the tax returns on time. And then a reminder that we have an extended net operating loss carryback period right now, which is at risk in the current Congress. However, it is still the law for 2020. Losses for 2020 can be carried back 5 years. Losses for 2019 can be carried back 5 years. Losses for 2018 can be carried back 5 years. It is really important for you to take another look at the losses your clients have endured. We're going to talk a little bit more about that. That's really important, but because the 2020 return is the last chance to take advantage of that 5-year carryback period. Then a car salesman could not convince the IRS to give him a second chance to settle a tax liability for pennies on the dollar. We'll talk a little bit more about that. And a warning: beware promoted, questionable domestic production activities deduction claims on amended returns. The IRS will refer you to the Office of Professional Responsibility if you get tangled up in one of those. Talk about that a little bit more later too. And then finally this week, another practice unit. The IRS continues to publish its training materials and make them available to us, and we can use them for training our people. It's not very expensive, it's free. Okay, bankruptcy relief is stalled by the failure to file returns. Patrice Lynette Harold filed for bankruptcy, but her tax liability for 2008 was not dischargeable because she did not file a timely return for that year. There was no evidence that she timely mailed or faxed the return to the IRS. The critical word here is timely. If it's late, for bankruptcy relief purposes, it's as bad as if you don't file it. Bankruptcy Code Section 521 recites the debtor's duties in subsection F. That's where we require timely filing of all required tax returns as a condition of bankruptcy protection. It's pretty straightforward. We typically have not worked in the bankruptcy code, very many of us, for very, very often, but we do need to familiarize ourselves, particularly with Chapter 5 and the provisions in Chapter 5 which deal with tax liabilities, because we are going to have clients that are driven into bankruptcy by the various after effects or concurrent effects of the COVID-19 pandemic. Next, about that 5-year NOL carryback. It may not last, but it is the law now. And I want to refer you to an article in Tax Notes Today on February 25th by Jad Chamsadine. Net operating loss provision was enacted in the coronavirus relief legislation last year in the CARES Act. For right now, it appears to be safe, but judging from the debate, the commentator who wrote this article believes that its future is far from certain. So for right now, losses through 2020 are eligible for carryback to each of the 5 years preceding the loss year. This was not available. If you look up net operating loss on the internet, the first 10 hits you get are going to be wrong because they don't tell you about this change in the CARES Act. The CARES Act amended Code Section 172B1. And if you don't have the most recent information, you're going to miss this opportunity to carry your client's losses in 2020 back 5 years. If you miss that, you should be shot. Okay, the IRS is free to reject an inadequate offer in compromise. Craig Galloway made a couple $100,000 a year. He owed the IRS a lot of money. I think he owed him like $800,000. And he offered to pay him $8,000 to settle the whole liability. The IRS declined his offer, and Mr. Galloway thought that was an abuse of discretion. The tax court in memo 2021-24 said no, the IRS settlement officer did not abuse her discretion by refusing to consider your car salesman your previously rejected offer in compromise. And the court upheld a filing of a notice of federal tax lien against Mr. Galloway, noting that he is free to submit another collection alternative in the form of another offer in compromise or in the form of an installment agreement, but he will not succeed in trying to browbeat the settlement officer into taking an offer that she had refused as inadequate. The settlement officer has that discretion. His only option was to come back with a better offer. Surely a car salesman ought to understand the would you take and the back and forth with an offer and a counter offer and an offer and a counter offer. Who better than a car salesman, right? The IRS is on the alert. Notice the illustration I picked up from clip art. On the alert for questionable domestic production activity deduction refund claims. Actually, the domestic production activity refund claims, the DPAD is the most recent version of the original domestic production encouragement, which was a reduction in my income tax rate. IRS reports they have a wave of questionable amended returns claiming the domestic production activities deduction, and the examiners have been instructed to consider imposing penalties for excessive refund claims and referring practitioners to the OPR for unsupported domestic production activities deductions. And folks, if you think it can't get serious, I refer you to the current information on disciplinary actions against practitioners. At least a dozen CPAs in the past 60 days have been disciplined for failing to approach their work with full professional integrity and actually knowing what they're doing. They weren't competent. They weren't competent to do the work they undertook, or they tried to take advantage. Take a look at Circular 230, sections 10.22 and 10.34 if you doubt what I'm telling you. Section 10.34A, B, C, and D makes you responsible for an unreasonable position in a tax return with your client. Your client may be responsible, but you're going to be responsible as well, and you're going to have to answer to the Office of Professional Responsibility. It isn't worth it. These promoted refund claims, these high binders, promoters have got a great deal for your client. Some of them work for a percentage of the recovery. If you can catch it before your client gets sucked in, please show them this article. Maybe it'll help. Now, a 263A calculation for producers. The IRS practice unit. This is one of 3 slides. This is the longest segment in this week's podcast. There's your citation, COR-P-020, made available on February 25th, 2021, a 39-page PowerPoint slide presentation that explains the application of the uniform capitalization of costs under 263 Cap A for a taxpayer who is a producer, and goes on to suggest audit techniques when an IRS auditor is examining a producer's Section 263 Cap A computation. The material to which I refer focuses on the simplified production method with the adjustment calculated in 7 steps. The 7 steps the auditor is instructed to follow are, in order, determine whether the taxpayer is a producer or a reseller. The law applies differently. I suppose today, the first thing we would do is determine whether the taxpayer has average annual gross receipts in excess of $25 million. If the average annual gross receipts are less than $25 million, 263 Cap A will not apply. So if the average annual gross receipts now, since the most recent change in the law, currently, if the average annual gross receipts are more than $25 million, 263 Cap A will not apply. So let's agree that we're talking about a taxpayer to whom 263 Cap A does apply. The auditor will determine whether the taxpayer is a producer or a reseller. The rules operate slightly differently. Then the auditor will identify Section 471 costs. What costs are inventoriable? And then identify additional Section 263 Cap A costs. In addition to the basic 471 costs, what costs would be required to be capitalized by 263 Cap A? That is, they are not period costs. They are determined to be costs related to producing goods that will produce revenue in a subsequent period. Then you allocate the mixed service costs to production activities, then capitalize the 263A costs that are present in the ending inventory by crediting current expenses and debiting inventory. At the end of all that, evaluate the taxpayer's method. Did the taxpayer's method come up with the same answer that the examiner came up with? That would be wonderful, fortunate. But if the taxpayer's method does not agree with the examiner's method, then impose a change in accounting method. How do we do that? Check the instructions for the Form 3115. That's how you do that. The unit focuses on the simplified production method, as I mentioned earlier, with the adjustment calculated in those 7 steps we just talked about, followed by this instructional material to help the auditor: definitions of terms and acronyms, other considerations, an index of referenced resources, training and additional resources, and that is some other units, some other training units that relate to 263 Cap A and uniform capitalization, and then a glossary of terms, and finally an index of related practice units, other practice units that touch on 263 Cap A. And as I mentioned, you can take some comfort in the most recent increase to $25 million a year, the gross receipts threshold for applying 263 Cap A to a taxpayer's costs of production. That's it, gang. That's it for this week. And with all the sincerity I can muster, until next time, please stay safe. If you need me, there's my email address, there's my phone number. I'm always available to answer tax questions and to help you with the tough decisions.